This is your Wall Street wake-up call. Oil prices dipped back below $40 yesterday for the first time since April. Joining me now is David Leibowitz, the global market strategist at JP Asset Management. So, David, there seems to be continued supply worries across the market, right?
Yes, and I think that that's key. These are supply-driven changes in price, not demand-driven. Demand has been pretty steady here. I expect that if we dip below $40 sustainably, you will hear that drumbeat of weaker global demand come back into play. But right now, this seems to be supply-driven, primarily what's gone on with Saudi Arabia and the reopening of the ports in Libya.
Well, that global growth drum sort of dominated the markets towards the beginning of the year. If that happens again, I mean, what does that mean for stocks?
So I think that if we begin to see fears around another global growth scare, it's obviously going to be negative for risk assets in general. I think you'll see those more defensive names, the income-producing names that have caught a bid all year, continue to garner support, obviously seeing those more cyclical sectors, which have rallied so hard since Brexit, sell off a little bit.
All right, now investors, like I mentioned, have been obsessed with oil for most of the first half of the year. But, I mean, are investors sort of tone deaf to some of these factors right now? Oil, China, Brexit, earnings. I mean, the investors know the central banks are going to be there to help them, back them up.
I think that there's definitely a global central bank put in play, but I would also say that the earnings picture is getting a little bit brighter. Despite weak second quarter growth in the U.S., we understand why it was weak. We lost over a full percentage point given the drawdown in inventories. China seems to have stabilized. I'm not sure things are going to get better there, but it seems like they're not going to get worse. So I think investors are shrugging a lot of this off for good reason. What happens with oil, though, remains to be seen, and I would expect that if we see oil come under pressure, and that particularly coincides with a stronger dollar, you may see emerging markets, which are up 12% this year, in dollar terms, begin to sell off a little bit.
All right. So the rally in U.S. stocks, the S&P 500, is that set to continue in your view in the near term?
My view is with the earnings picture getting better, there's more fundamental support for U.S. equities. So we have about 1 week to go before we have the majority of companies in the door. There are a lot of energy names reporting this week, so we need to watch estimates closely. My guess is that they'll come down a little bit. But as we get third quarter, fourth quarter results, our view is that earnings growth is going to gradually turn positive, and that should provide support for stocks to push higher into the end of the year.
All right. Now, does August worry you? Because a year ago at this time, of course, no one foresaw that correction that ended up happening at the end of the month. What's your take on the possibility of something like that happening again?
So I'm not thinking that we're going to see as severe of a correction this August as we did last August, but some of the same factors are coming into play. You're hearing them talk about the possibility of a Fed rate hike. That's increasing, with some people pointing to September, most people pointing to December. We have stable data out of China. There is the ability for that to deteriorate. But as far as I'm concerned, investors really need to be watching the next two jobs reports and Chairman Yellen's testimony at Jackson Hole at the end of the month. I think those three pieces of information are going to give us the best view as to the trajectory of risk assets over the coming months.
All right, and we get that July jobs report on Friday. David Leibowitz from JP Asset Management, thanks so much for your time.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.